My name is Ashley Jones. I'm the Managing Director of Community Programs here at the Venture Center, and we've got a great workshop for you today. Here with us are Shep, Campbell and Ashton, Woodward. They are two intermediaries with CBI of Central Arkansas. They're here to talk about the ins and outs of venture capital and some alternatives to consider when starting and growing your tech company. Before I hand it over to them, I do want to thank our sponsors for today's programs and all of our programs that we have throughout the year, Wright Lindsay Jennings, Frost, and the Little Rock Regional Chamber for all of their continued support, whether in person or virtually. So thank you to you guys. I do want to go ahead and pass it over to Shep and Ashton. We will save room at the end for questions. You can use the chat box or unmute yourself, but for now, if you are not a presenter, go ahead and mute yourself. And I will turn it over to Shep and Ashton.
Thank you.
Great. Thanks, Ashley. Appreciate it. My name is Shep Campbell. Appreciate the Venture Center for putting this on today, and all y'all tuning in and on Zoom and via Facebook Live. So I'm going to go ahead and share my screen. Can everybody see that, I assume? Let's see here. Okay, so like Ashley said, we work for a company here in Little Rock called CBI of Central Arkansas. And what we do is we help people essentially buy and sell businesses. We work primarily along the with Main Street businesses, considered 5 million in revenues or less, depending on who you talk to. But we've also done a lot of deals and have worked very heavily in the technology industry, advising on what we call middle market deals with larger companies. And we're going to talk about one of the things that we discovered while working with technology companies is funding is tough for startup and young tech companies out there. And we kind of stumbled into this deal, that case study that we're going to go over today, but I'll go ahead and get started. And basically what we're talking about is the problem that really everybody faces. And that problem is simply capital. Everybody needs capital for their businesses. You know, there are limited resources to utilize when seeking capital. And it basically comes in two forms. And what I mean by that is if someone's going to give you money, it's going to be along one of two lines, either debt in the form of debt, which is kind of the traditional way that we work with these small businesses, being a loan from some entity, usually a bank. Can be a bank, credit union, whoever it may be, can be a friend, can be a private equity group or a private investment group. And then there's equity. When you talk about equity, people are giving you money, and they're doing that for a percentage of ownership typically. Can look like a number of different things, but the basic idea is I give you X amount of dollars and I get a percentage of ownership of your company. So when it comes to banks, usually they're the first stop. But what you find is banks are asset lenders. They seek collateral, usually along the lines of equipment. And it's not just your chairs and desks and computers. They won't loan on that. Restaurants, they're not going to loan on restaurant equipment. They're seeking heavy equipment, hard assets of some sort, real estate. Typically, they need financial data of at least 2 years, personal guarantees, all of which a lot of technology companies don't possess. Most tech companies don't possess heavy equipment that they're using. Most tech companies have an idea. An idea is goodwill. It's an intangible asset. It's not something that a bank typically loans on. So startups, if you're a startup tech company, if you're just beginning, you don't have a lot of historical financial data. And in addition, a lot of technology companies don't show profitability. And that's true really for any business. The first 2 to 3 years of any business don't show profitability. Both of those are negatives in the eyes of a bank. So what you get into is SBA loans. They may or may not be available for tech companies. And SBA stands for Small Business Administration. And they don't loan money. You hear SBA loans all the time. The SBA is not loaning money. What the SBA is doing is guaranteeing that loan for that lender. But they're very onerous. They require personal assets to be wrapped up, houses, whatever else there may be. And they can take a significant amount of time. It's like anything that has to do with the government. It's red tape, red tape, red tape when it gets to the SBA. And they're not guaranteed to necessarily loan if you don't have some of those things. Let me get there they are, all right. So common solutions that people typically turn to if they can't obtain a loan from the bank or from the SBA, family and friends, oftentimes very limited. You can only go, you've heard the saying, you can only go to the well so many times. You can only ask mom and dad or Uncle Joe or rich Aunt Mary so many times. Sooner or later you run out. Crowdfunding, that's kind of the catchy, trendy thing these days. But even with crowdfunding, it doesn't take a lot of research to see that you get mixed reviews at best when it comes to crowdfunding. So basically, for technology companies, what we've discovered, there are primarily two resources of real money available. Those two resources being angel investors. Typically, they're going to be individuals. And keep in mind that with angel investors, they're coming in at the front end of the deal. They're typically what's called early stage or pre-seed investors. We'll talk to kind of outline their profile here coming up. And then you've got venture capital firms, firms and companies. Each of these two have their pros and cons. But as will be seen, each typically requires an equity stake in the company, and it can be a very high and onerous equity stake in your company. So angel investors, to kind of start there, they're high net worth individuals typically. They're usually going to invest in early stage startups. Maybe the business hasn't even taken off yet. They're going to fund your idea. Think Shark Tank when it comes to angel investors. They're looking for higher returns than you can typically get from the stock market. Bonds these days, if anybody's familiar with the bond market, bonds aren't paying anything. The stock market, it's up and down. If you take the last 75 years, the stock market's going to average about 8%. So these high net worth individuals, they're invested in those areas, but they also have money available where they're seeking higher returns. The average investment is going to be about $330,000 from an angel investor. On the high end, it's going to be about $750,000, and that's on the very high end. They tend to invest in industries they know, that they've been familiar with or associated with. And then they tend to invest in people they know or have a connection with. So the angel investor may not be a fit for a certain technology company. Angel investors are going to expect returns of 20 to 25% or more. But usually their investment in the VC is going to be like this as well. They don't have to be repaid. It's not a loan. Remember, they're not giving you a debt. Well, it is a loan, but it's not a debt. You don't have to repay it because they're going to seek an equity stake of ownership in your company. And they're going to have terms and conditions that repay them. And consequently, they're going to have a high degree of involvement in your company. So that leads us to the venture capitalist. And venture capital basically consists of four players. You've got the entrepreneur. Those are you people out there who have an idea, business owners or entrepreneurs, people who don't want to work for anybody else. They need money oftentimes. You've got investors who are seeking high returns, whether it's the angel investor or private equity group, private investment group. We call them pigs and pegs. Investment banks. The investment banks need to sell companies, whether it's selling companies or initial public offerings. And so you have a void between those three people, and that's where the venture capitalist comes in. They make money by creating a market. They create a market for the entrepreneur to sell their idea and their business. They fund it. They provide high returns for the investor, and they're going to supply the investment banks with companies to sell. You see that played out in this diagram right here. Okay? So basically what you have is the entrepreneur. Entrepreneurs can get money from corporations and government grants to start their company, but in the end, that's just to get it going. In order to take it further, even if they seek an angel investor to take that vision to its end, they need money. They've got an idea, they give the venture capitalist an idea. Basically, that idea is going to be in the form of equity in your company. And in return, venture capitalist gives the entrepreneur money. But that money is going to come at a cost, because the end game for the venture capitalist is either sell your company or an initial public offering. Investment banks need companies to sell. They're giving money to the venture capitalist, who in turn is going to give them a company that they can take public, that they can sell stock for in exchange for money. And you see the venture capitalist is right in the middle of it all. So the VC provides a market. They fill the void between innovation and traditional sources of capital, typically a bank. Okay? Banks, keep in mind, typically fund ongoing concerns, brick and mortar small business enterprises, large business enterprises. VC funds are usually limited partnerships, groups of people, where they create a fund either by their own money and by other people's money, and that fund is run by a general partner, a GP, or general partners. So the VC firm is not investing their own money, but investing money of others. Investment companies, those pegs and pigs we referenced earlier, large corporations, pension funds, and believe it or not, university endowments will oftentimes set aside a small portion of their portfolio for that VC, because they know it's a small portion of our overall portfolio, but that venture capital can return exceptionally high returns, can provide exceptionally high returns. So it's high reward, high risk. So those endowments will give a small portion. If they lose, well, it's just a small portion of our portfolio. We haven't lost much overall. If they win, they typically win big. So the venture capital then, they're not so much concerned about industries that they know. They typically invest in already established companies, not necessarily 10-year-old companies, but 3, 4, 5-year-old, 6-year-old companies, companies that have shown progress, that have a history of success, or at least the potential for success. They're going to look for fast-growing industries. They're going to look for high-growth segments, which these days, what's a high-growth segment? Fintech is a high-growth segment, an extremely high-growth segment. AI, artificial intelligence, the internet, technology space, fits that criteria of providing potentially fast, high returns. That's what's called a high-growth segment. So that's why when you look at the current disbursements between venture capitalists, more than a quarter of it, 25%, is in that internet technology space, which that's fintech, SaaS, PaaS. AI is really an emerging sector, and anything to do with technology and internet. Whereas the average investment of an angel investor, if you remember, was about $330,000. The average investment from a venture capital firm is between 7 and 12 million. In 2018, the average investment was about 11.7 million. So a significantly higher sum of money is being put into your company, but with that comes a lot of expectations. So here are just some general stats, and I'm not going to go read through these. But basically, you're looking at in 2018 and 19 have been record-breaking years for venture capitalists and even angel investors. Billions, literally billions of dollars flowing through that pipeline. Dry powder there is essentially cash equivalents, investments that have not yet materialized but are out there invested in works. angel and seed investing, you can see there, is interesting. It's 5 times more active than it was 10 years ago. It's just staggering when you look at some of these. In first quarter 2020, there were 49 late stage venture capital, what's called mega deals. A mega deal is $100 million or more. So there's an exceptionally large amount of money flowing through the venture capital networks, pipelines right now. Fintech sees a lot of it. In 2018, over 1,000 deals closed. The total value of $14.5 billion. In 2019, the average fintech deal for venture capitals was $20.9 million. And in the first quarter of 2020, obviously the COVID effect is gonna have an impact on the rest of the year. But in the first quarter, the average deal in fintech was 23 million. And most of these deals are occurring with late stage companies. They've been through several rounds of funding. They've gotten the idea off the ground. Now they need to rapidly grow and expand. So the catch, all of that sounds great. There's a lot of money flowing through it. There's a lot of success stories out there in regards to VC, but there's a catch. There's always a catch. They're all about the return, meaning on average, a 25% return for a VC is just average. Some might even say, well, that's, whatever. They're looking for 35% or more. On average, 2 out of 10 or 1 out of 20, depending on who you read, of VC investments are a success. Of course, the ones we read about are the success stories. The ones you don't hear about are the ones that didn't work out. And that's the overwhelming majority. Even in baseball, you bat 100, 200, you're not going to get very far. So there's a lot of misses as opposed to the hits. The 1 to 2 companies that are a success, man, they have to produce exceptionally high returns. The overall fund may have 10 investments. 2 of them pan out. In order to get that 20% minimum return they're seeking, those 2 investments have to be about 30 times what they were invested in initially. That's just an extremely high return. And I don't want to get too far into the weeds with math. I wasn't very good at math myself. But basically, these VC firms are expecting about 10 times what they put in over a 5-year period. There was a guy here, you can see Bob Zeider did the math. If you take a 10-time return on capital over a 5-year period, and then we'll talk about some of these preferred positions and stipulations that come with it, he calculated that it's a loan with a 58% compound interest rate that essentially cannot be prepaid. That's a very, very high cost of capital. Can you imagine a bank telling you got a 58% interest rate? So VC can come with a very high price. They're going to want an equity stake in your company, just like angel investors, and rightfully so. If we're going to fund you with a $12 million investment, then we want a piece of it. That's going to be a form on the seat, a seat on the board, perhaps even control of the company, oftentimes control of the company. They're going to want to say on the direction and strategy that the company takes. And the thing about a VC, you're just getting your company started, but you better have an exit in mind. And these come with several clauses. And here's just a couple of the clauses, and I won't get too much into this, but they are interesting to know. For instance, the preemptive right there. Let's say the shareholder, the VC firm has a certain percentage position. If that company needs to acquire additional capital outside that VC firm and they issue additional shares, well, that preemptive right means that VC company has the right to maintain their same percentage of ownership. So they're going to eat up some of those additional shares. The tag along, drag along basically means whether that venture capital is in the majority or in the minority, they're still going to be taken care of if you issue additional shares and try to raise additional capital. Liquidation features, co-sell rights, basically saying you can't sell this company unless we let you sell this company. Even if you get an exceptionally high offer, if it's not the return that VC firm is looking for, even if that venture capital firm is in a minority position, they're still going to have the say-so on whether you sell or not. And all of those clauses are designed to protect the venture capitalist. Sometimes it comes at the expense of the company itself, the shareholders of that company, the other shareholders, and that includes ownership and oftentimes the management team. A venture capital firm may come in and say, hey, you know, we want to replace a certain position on the management team. Regardless of whether that's your best friend of 20 years, if you want their money, you're going to have to follow their rules. So in certain situations, companies lose a high degree of autonomy. And oftentimes the strategy and the vision can be reshaped. Because again, remember, it's all about the return for the venture capitalist. Ben Sun is a guy that has been in venture capital for several years. He had a very interesting quote. If you do take VC money, and he's a venture capitalist himself, be ready to realign your personal incentives to more closely match theirs, or set your terms so they don't get to completely control your destiny. So again, VC money can be great. There are a lot of success stories. And I'm not trying to demonize venture capital because they provide a market. They provide an outstanding opportunity. But it's not all puppy dogs and sunshine. There's a lot that comes with that, and there are other ways. Mergers is primarily what we're talking about here, and we're going to give you a case study that Ashton's going to talk about very shortly. Just quickly, a definition of a merger is a combination of two things, especially companies into one. In the business sense of the word, it's when one company called the acquirer purchases another company called the target, and they basically merge and become one company. The target is absorbed either as a standalone subsidiary or fully integrated into the company itself. The strategic buyer, and this is what Ashton's getting ready to talk about. In fact, Ashton, why don't you just take it from here?
Sure, Shep. My name's Ashton Woodward. I'm also a CBI intermediary. And I'm going to be discussing a deal that Shep and I completed for Wayland Tech last December. We started with Wayland Tech probably in October, I would say. Isn't that correct, Shep?
Yes.
And our task was outlined as defining an acquisition that would enable Wayland to uplist, and they are currently in the OTCQX market, which is the pink sheets, and their desire was to uplist out of that market and into either the NASDAQ or the NYSE. So the way that this relationship started is actually a pretty interesting story. Shep and I came into contact with Brent Sun, the CEO, because we were interested in having an app developed, some ideas that Shep had. And Brent is in this field, not to get off on a tangent there, but we ended up getting the call back from Brent, and he was interested in us managing this acquisition. So if you'll skip to the next slide, please, Shep. Okay, so once we had the parameters of our search outlined for Wayland Tech, what we quickly realized is that thousands of companies in the United States fit the bill for what Wayland needed: a U.S. footprint, and that would enable them to uplist this company onto the NYSE or the NASDAQ. Push Interactive out of Minneapolis was a prime target for acquisition because it fit the revenue range that the Wayland team was looking for. And in addition to that, the U.S. operations were a necessity. Go ahead and skip forward for me, Shep, if you will. There's the CEO, Brent Sun, and a lot of what Wayland does in the Southeast Asian in the Southeast Asian markets is provide SaaS and PaaS software for the enablement of small to medium SMBs, small to medium sized businesses. So go ahead and skip forward, Shep. So some of the Wayland subsidiaries, ATOS Pay, ATOS Go, and Create App. What Create App is the SaaS and PaaS element of Wayland, and what they focus on is emerging markets where most transactions between the B2C happen on a cell phone basis. That is, cashless ecosystems where money is transferred from cell phone to pay for goods, such as foods at food vendor stalls or what have you. ATOS Pay is the subsidiary for Wayland Tech, which focuses on m-commerce. They enable the payments for these apps. And then ATOS Go is basically a courier service throughout certain Southeast Asian countries. And unlike Uber Eats per se or DoorDash, they focus on foot delivery, which is not something we're familiar with here in the United States. Go ahead to the next slide, Shep. Emerging markets, you've heard me use that term already, refers to a lot of the Southeast Asian countries that you would describe as being traditionally bankless. I realize Hong Kong and South Korea do not fit that bill. These are countries where Wayland currently does business. Go ahead and skip forward, Shep. All right. So in the beginning of our search process, we narrowed down a list of about 7,000 tech-related companies to around 300. And that list was narrowed based on location, revenues, the industry, the performance metrics. All of the above were taken into account when we were looking for a perfect acquisition. Go ahead and skip forward. So Conversion Point was a holding company that had purchased Push in 2017. And after an attempt at an IPO with Push Interactive, the company kind of faltered. It was undercapitalized, and after failing with the IPO, and this was right after Trump had kind of rattled the China battle saber, so to speak. Push was just kind of sitting stagnant for a little while. Conversion Point also, it is of interest to note, held Inuvo, which is a Arkansas company, and go ahead and skip to the next frame, Shep. So founded in 2010, Push specializes in direct-to-consumer marketing. And so you start to see that there is a great deal of synergy between what Wayland does and what Push does. Through AI targeting and media optimization and customer engagement and acquisition, Push helps brands increase their recognition in whatever niche market they may be. So, yes, sir.
Yeah, if I can jump in just for a second here. Also keep in mind, you know, Wayland needed an American footprint.
Right.
So what they were doing in Southeast Asia with their digital wallet, ATOS Pay, with their Create app to medium to small size businesses, Push was doing marketing, online marketing, brand optimization, data analysis, and targeting in the US. So the synergy there was Push can work with our Create app. And there was some commonality with shareholders. There was some commonality with Conversion Point. that just kind of made sense once that push IPO had failed. So again, you've got a strategic seller, but you've also got a strategic buyer out there as well.
Right, and as Shep said, there was a great deal of synergy between what these subsidiaries of Wayland do and what Push is currently doing. Next slide, if you will. So some of the projects Push has worked on include the following on your screen: Astrology Nova, Easy Refinance Wizard, Simple Job Finder, Simple Mortgage Finder, Easy Auto Quotes, and Policy Guru. These are all internet-based companies operating out of America, and although they're not, small businesses, what Push is doing to help these companies gain traction in their given markets is definitely applicable to what Wayland is wanting within their United States footprint. Next slide, if you will. So the approach in this acquisition stands as a contrast to what many of us know as VC or private equity group acquisition. A lot of importance was placed on company culture and finding compatible personalities that would work for Wayland Tech. The management at Push was retained for this reason. These are all people who fit very, very well together as far as their business mentality. And future plans, it's interesting to note, were not laid out as far as what Wayland and Push would do together. So what you've got there is a very organic sense of, let's grow this together. We don't necessarily have to have defined plans for what that growth will be. And Shep, I think you would agree, that's quite a unique thing in middle market acquisitions. You don't see a lot of that emphasis placed on company culture and the acquisition of personality, so to speak.
There's no doubt, Push was allowed to maintain a high degree of autonomy,
Yes.
Brent told us this from the get-go. I don't want to purchase another job. I want a company that the management is passionate, energetic, and ready to grow their own company. And we're going to give them access to capital through a publicly traded company, being us, Wayland, that they otherwise would not have. And so Push has had, the goal was, and they have since maintained a very, very high degree of autonomy. They've continued to pursue their goals and strategies they had in place before the acquisition, and they've had access to Wayland's capital and financial resources as the publicly traded company.
Go ahead to the next slide, if you will. So with this high degree of autonomy, an entrepreneur wants to be an entrepreneur. Nobody starts their own business wishing for another boss. We all want to be our own boss in the entrepreneurial pursuit. And Push wanted to expand, but in needing the capital to do so, with the VC route, as we've discussed, a lot of times you're basically adopting a new boss in exchange for equity in your company. Push management was not interested in cashing out. They were interested in maintaining the leadership roles within their company. And so what you've got in the Wayland acquisition of Push is a very unique thing. Go ahead to the next slide, Shep. So what Push gets out of this deal is access to the publicly traded company's financial resources, the autonomy. The strategy and goals obviously become one, but with proper capital in place, you've got the ability to make those goals happen. Wayland gets out of this deal to acquire and expand their footprint into the United States, a potential to uplist into a senior exchange in the NASDAQ or the NYSE, and they get a bigger team that's ready to grow and expand with them. Go ahead to the next slide, if you will. So I'm going to discuss some of the mechanics of this deal, because this is something that I get asked about a lot. This deal would be described as a stock purchase with a earnout that Shep and I authored. The mechanics of the deal, we performed the valuation. 21.5 million is what our numbers suggested the value of Push to be worth, using industry metrics. You know, and when you look at one of these deals, 21.5 million describes a middle market deal, anything above 10 million on up to about the $1 billion range. Typically, you'll see an earnout of some sort utilized. And what that oftentimes does is it bridges the gap between what the target company feels they are worth and what the parent company, the acquirer, feels that they are worth. In this case, there was no disagreement upon price. 21.5 million was accepted by both parties as a proper valuation amount. And then a premium was assigned to that, bringing it up to 25 million. So this was an all stock purchase. Wayland Tech stock was exchanged to Push for ownership. And initially, we had authored it as a 25% down with 75% of the stock built into the earnout period. That later got reversed in the deal to be 75% down and 25% paid on the contingent performance of the company. So the reason we did that is you had Conversion Point, the holding company, needing to be cashed out. So 25% down didn't cut it. 75% was required to get this deal rolling. So the remaining 25% of the stock is paid contingent on performance benchmarks over an 18-month period. So that's 3 6-month tiers. So every 6 months, certain performance metrics are analyzed, and stock is paid out to Push's management based on either meeting or exceeding or falling short of those parameters. So the deal also includes the ability for Push management to, if they should exceed those benchmarks, to make another 5 million in additional shares of Wayland Tech. Go ahead to the next slide, if you will. So on December 12th, we closed the deal in Minneapolis, which was probably one of the coldest trips that I've ever been on. Shep may agree with that.
Was it 7 degrees when we stepped off?
Yeah, I think 6 or 7 degrees.
To 7 in Minneapolis. Yeah. Avoid Minneapolis in December.
So Push is currently exceeding the benchmark requirements, and some of the requirements that they had in place were, certain EBITDA, gross profit margins, and run rates. Push did not have to make any management changes, as we mentioned before. Their strategy and goals remain in place, but the capital is now added to the company that enables those goals to become a reality. This was a synergistic merging of two companies, and their growth and expansion is now, you've got a lot more possibility, especially with the coming uplisting of this company.
And it's no accident or coincidence that Wayland had a record fourth quarter last year. They had a record 2019, and this year so far, despite COVID, they're on pace to exceed those benchmarks in large in large part to what Push has brought to the table and the performance they've had as well.
So, as we've mentioned in Shep's beginning of the presentation, there are options outside of the traditional VC or angel investment path. Companies like Wayland Tech exist. The strategic buyer and the strategic seller seeking capital can forge a relationship that is more meaningful and synergistic to both companies. Getting to run your own company as you see fit is part of the entrepreneurial goal. So what you've got in Push is a company that got paid to sell, and then they got to run their own company. It's like the best of both worlds type scenario. So we already discussed the earnout for Push Interactive, and the fact that they are on par to meet or exceed the benchmarks of our earnout. Now they're basically a subsidiary of the parent company Wayland Tech, and as stated, the growth is unlimited for these subsidiaries to assist each other and enable this growth within the U.S. market.
So, and I'll close out, but I want to back up and touch on something about the earnout. It's got to be a thing, and whether it's a $250,000 Main Street deal, a $25 million deal, or a multi-billion-dollar acquisition, it has to work for both sides. And so we had things structured within the earnout that if the incentive was there for Wayland or for Push to exceed the benchmarks because they would get basically the bonus of $5 million. If they failed to meet that benchmark, then whatever that disbursement was for that tier was withheld. So if they failed to reach it by 5%, then 5% of the disbursement that was due was withheld. So there were penalties and there were bonuses. But what we did was at the end of it all, we essentially had what we called a catch-up clause. So over the course of the 18-month period, there would have been 3 disbursements each 6 months. If you failed to reach the number that we had set, then there was an additional period of time that's been allotted that if you perform along these parameters, you'll be able to regain those lost disbursements, the lost shares, the lost value. We called it the catch-up clause. So it's a deal where it's a situation where it's structured, like Ashton said, he put it a good way. The earnout bridges what the buyer wants to pay and what the seller feels like they're worth. And if you're going to have an earnout, again, I don't care if it's a Main Street business. We did one for $1 million 2 years ago on a construction company out of North Little Rock. We've done them for $500,000, or a $25 million deal. It has to work for both sides. If you're going to put in bonuses and penalties, then it needs to be fair. And in this one, both sides were very agreeable, and it worked out. It worked out in the end. And yeah, companies like Wayland exist. The thing is, how do you find them? It's kind of like anything else. How do you find these companies? That's where we came in. That's where we have a program within our company called the Targeted Acquisition Program. We work taps for sellers and buyers. Perhaps you're a buyer like Wayland, looking to expand your footprint, looking to enter another market. Whatever it may be, we can go out and find companies that want to sell. Kind of the TAP motto is, because the company you want to buy is not for sale. On the flip side of that, if you're a young startup tech company and this sounds attractive to you and you don't want to give up a large degree of autonomy and control, we can help you find those strategic buyers, those companies like Wayland Tech that are looking to expand, but not necessarily buy another job. It's customized, the TAP, our targeted acquisition program. We customize it to the client's needs, whatever their goals are, whatever their criteria is. We step in and run the program from A to Z, which allows our client to run their business. It's very detail-oriented, buying and selling businesses, going out and looking. In fact, Waylon just kind of gave us some parameters last week on companies they want us to go out and find. And over the last several days, we've been working on data companies and things of that nature. So we can help you find what you want, whether you're a seller looking to expand, whether you're a buyer looking to expand, whatever angle, whatever side you're coming at it from, we've worked both sides and can help you. Just a little background before we close out. We've been in business since '94, Arkansas based, started up in Springdale. We've got offices now all over, I think 3 in Arkansas, 1 in Tulsa, but we do deals all over the country. But the way the internet is these days, we do deals, really, I deal with sellers and buyers all over the world, literally. We've dealt with buyers from Europe, from Central South America, from South Africa. So we have a broad footprint. We've done a lot of M&A activity most recently in technology, but we sold a $16 million orthodontics firm up in Northwest Arkansas not too long ago. So we like to say we're a mile wide and an inch deep, if that makes any sense. And that's our website right there that you can visit, cbicentralarkansas.com. If you go to cbiteam.com, that's going to give you our Northwest Arkansas office, and you can kind of see a little bit about who we are and what we do. But in the end, we're about customizing this program to our clients' needs. We're about doing whatever it takes to get the deal done, and we'll go out and look wherever we need to look, do whatever we got to do. And if you're interested in learning more, we're about to open it up for questions, Ashley, if that's okay. But here's our contact. I'll leave this screen up here. You can see Ashton's email and cell phone, my email and cell phone. I used to be a football coach back in my first life, so I lived in about 20 different cities, which is why I have an 870 area code. I finally got sick of changing my phone number, so I just kept the last one I had. But I live and work out of our Little Rock office here in Central Arkansas. Ashley, we'll take questions right now, if that's okay, if there are any questions.
Absolutely. We do want to open it up for questions. If you have a question, you can go ahead and drop it in the chat box, or you can go ahead and unmute yourself and ask the question. We do have one that came through. How does CBI charge for their services?
Yeah, that's a good question. So it kind of depends. If it's a typical listing, we usually do have an upfront fee. It's very nominal, usually around $2,000 to $3,000. From a typical Main Street business perspective, what we're going to do is confidentially market your business on several websites. We're going to do direct mail campaigns in and out of your market to competitors, to similar businesses all over. We work full time. It's a non-refundable fee, and it just helps us cover the expenses of what we do to market the business. It's like I tell sellers on the front end, we don't try to hide anything from you, but we want to know that you're motivated. We're looking for motivated buyers when we list your business, and we want to know that the seller's motivated and put a little skin in the game to help us cover some of those upfront expenses. The only way we get paid per se is if we sell the business, and typically our commission is 10% of the sales price. Again, from a typical listing perspective, in Waylon's situation, it was we took about a 4% commission on a $25 million deal. Obviously, we're going to work with a situation like that. We're very flexible. Along the TAP program, we have what's called a project management fee, and that's determined by the size of the assignment. If it's a 50 business TAP, it'll be a smaller management fee. If we're going nationwide or globally, it'll be a larger management fee. So it moves. But one thing we do assure our clients is we're going to tell you exactly what it costs before we try to get you to sign the engagement. We're not going to try to slip it in there at the last minute. We do get paid a commission as well on the back end of a TAP program. And oftentimes we can work on what that commission looks like.
Yes, and I'd also like to mention, if it's okay, Shep,
Yeah.
with our sell side engagement with a person wanting to sell their business, yes, there is an upfront cost and it is a 1-year engagement. However, you don't get charged that again at the end of the year. Once you've paid that, you pay it once and once only. If it takes us a couple of years to sell the business, which is not outside of industry norms, you're not getting charged again for a second year of engagement.
That's right. The average length of time to sell a Main Street business is 12 to 18 months. You deal with banks, you know, in Wayland's situation, they're very aggressive. It was significantly less time to get the deal done because it didn't involve a bank. So, but if you're talking Main Street, you're talking small business, you're looking at a 12 to 18 month process. And Ashton's right. It's a one-time fee. I've had a business that took us 4 years to sell it. We never charged them another fee. If we don't sell it, we don't get paid.
Good to know. Anyone else? I do want to open it up. You can pose your question in the chat box or unmute yourself. You feel so inclined.
And I know some people, it's kind of like in church when they tell you to walk to the aisle at the end. Some people don't want to do that. So, you know, you got our email addresses there. You can shoot us a question via email. You can text Ashton or I, or give us a call. We'd love to visit and answer any questions that may pop up later.
Absolutely. Going once, going twice. Shep, if you want to unshare your screen.
Yes, ma'am.
As Shep said, if you do have a question, he had his email up there as well as Ashton's. We're happy to provide that with you as well if you reach out to us directly. Otherwise, thank you both so much, Shep and Ashton, for this session.
Thank you.
Our participants and attendees, thank you for viewing on Zoom as well as Facebook Live, and as well as our awesome sponsors, Wright Lindsay Jennings, Frost, and the Little Rock Regional Chamber. The Venture Center does have several programs coming up in the month of June, so we do encourage you to check out our Facebook page, our website, sign up for our newsletter so you know all that's going on here. With that, I think it's a wrap. Have a fantastic Friday. Enjoy the great weather and the beautiful weekend, and we hope to see you all again soon. Thank you, guys.
Thank you, Ashton.
Thanks, Venture Center. Y'all take care.
All right.